So today we're going to tear down a company called SJS Enterprises. They operate in the automotive aesthetic space. Now, I know that doesn't exactly scream excitement, does it? But trust me, what we're about to uncover is a masterclass in how a business that looks simple on the surface can hide some serious risks and some pretty incredible rewards.
Here's my promise to you for this explainer. By the time we're done, you're going to know exactly how this company really makes its money. You'll know the specific triggers that could permanently break this business, and you'll get my clear, no-nonsense verdict on whether I would put my own cash on the line here today.
All right, Section 1, the moat. We have to understand where the real value is created in this business. And let me give you a spoiler. It has very little to do with just manufacturing parts.
You know, you might think the biggest challenge for a company like SJS is just finding people to buy their stuff. But that's not it at all. The auto industry has tons of demand. The real battle, the thing that keeps them up at night, is staying essential, staying relevant, when the look and feel of a car is changing every few years. This isn't a volume game, it's a relevance game.
So, how do they stay relevant? It all comes down to this one critical concept: design integration. This is the absolute key to their entire model. It means SJS isn't just some supplier you call up when you need a part. No, they are in the room, right at the beginning, when a car's interior is nothing more than a sketch on a napkin. And getting in that early, it locks them in as the supplier for that car's entire life. We're talking 5, 6, even 7 years. That's huge.
And this chart right here just lays it all out perfectly. It's two different worlds. If SJS is integrated into the design, they have pricing power, their revenue is sticky, and it's a massive headache for the car company to switch away from them. But if they're not integrated, their margins get crushed, they become just another commodity supplier, and they can be replaced in a heartbeat. Everything, and I mean everything, depends on them living on the left side of this screen.
And this is the part most people get wrong. They hear auto supplier and they think, oh, more car sales must mean more profit. But that's not it. The real money for SJS isn't made by stamping out millions of simple little parts. It comes from that design lock-in we just talked about, and from the premium price they can charge for really complex, high-quality pieces that are a pain for anyone else to make.
Now, what about the elephant in the room? The huge shift to electric vehicles. For so many auto suppliers, that's a death sentence. Their business is tied to the engine, to the drivetrain, and poof, it's gone. But for SJS, it's a massive, massive opportunity. Think about it. When the engine disappears, how do car companies make their vehicles stand out? The focus shifts right inside the car, to the interior, the branding, the whole aesthetic experience. That is exactly where SJS operates. The EV transition isn't a threat. It's a powerful tailwind pushing them forward.
Okay, so the business model, the story. It sounds pretty solid, right? But does it actually hold up when you look at the financials? Let's find out. Time for Section 2. We're going to do a little financial forensic analysis to see if these numbers are the real deal.
Before we jump into the spreadsheets, just remember this one thing. It's almost never the raw numbers themselves that kill an investment. What really destroys your money is not understanding the story behind why those numbers are moving up or down. So our job right now is to find that story.
Now, anyone looking at SJS's recent history will see their profit margins took a bit of a hit, and that might scare people off. But let's perform a quick autopsy. What actually happened? Well, the pain came from investments for the future. They were spending money on tooling for new EV programs, and they got hit by short-term inflation. But look at what did not happen. This is so much more important. The business wasn't decaying. They didn't have order cancellations. They weren't losing customers. This wasn't a sick business. This was a healthy business investing in its future.
Okay, next up, the cash flow reality check. Here's a simple rule for a healthy business. The actual cash coming in the door should pretty much match the profits they're reporting. And guess what? For SJS, it does. It tracks beautifully. That tells us there are no accounting shenanigans going on, and it also gives us a clear red line. If that cash flow ever stops tracking their earnings, the whole investment case just falls apart.
Here's another one of my big risk filters: customer concentration. You never ever want to see a company where its entire fate rests on one single client. And as you can see here, SJS passes this test with flying colors. No one customer is more than a quarter of their sales, and they've got this really nice, healthy spread across cars, motorcycles, and commercial trucks. This is exactly what you want to see. It's beautifully diversified.
So, the business model is strong. The numbers look clean. But we are not done yet. In fact, we're moving on to maybe the most important part of all: the human factor. We have to look at management and define our non-negotiable exit triggers, our kill switches.
Because this is the ultimate test, isn't it?
It's easy for any management team to look like a hero when the economy is booming. The real measure of a leadership team, and the real safety of your investment, is seeing how they act when the cycle turns and things get tough. Discipline under pressure. That's everything.
So, these are the 5 real kill switches. These are non-negotiable. If car companies start bullying them on price, it means their moat is crumbling. If that cash flow stops tracking earnings for more than 2 quarters, something is fishy with the books. If the founders start buying, a chain of pizza restaurants, their discipline is gone. A sudden jump in what customers owe them, or the founders dumping a huge chunk of their stock for no reason, those are massive red flags. If you see any one of these, the investment thesis is broken. Period. You sell.
We've looked at the moat, we've dug through the numbers, and we've talked about the people. Now it is time to put it all together and get to the final verdict. A real, actionable investment decision.
After all of this analysis, it really just boils down to one simple question. It's not, is this a good company? The question is, should I actually put serious money here or not?
And my answer, based on everything that we've just walked through, is crystal clear. Today, yes, I would invest in SJS Enterprises.
But, and you have to hear this part, that yes comes with some very strict conditions. This is not a hot stock you trade for a quick gain. You have to treat this as a long-term compounder that you watch like a hawk. I would hit the reconsider button immediately if I see their margins get squeezed because of price cuts, if that cash flow quality starts to look funky, or if the founder's behavior changes. This is an investment that requires discipline.
And really, that's the perfect way to wrap this all up. An investment in SJS isn't going to make you feel like a genius overnight. It's not something you're going to brag about next week. But if you own it the right way, with patience and with a close eye on those key variables we talked about, this is exactly the kind of business that can just quietly, year after year, build serious wealth.